Hey guys, welcome back to Cover Caller. My name's Max. The title of today's video is ULTY done? Long story short, no, I don't think it's done, and I'm going to tell you why. But the reason I'm even asking the question is because two new competing high yield ETFs came out the last day of October. Tonight I'm going to talk about Kield or KYLD from Kurv and ULTI from Rexshares. Now, these two ETFs are similar to ULTY in a lot of respects. They have similar types of stocks in the portfolio. All three of them are able to move stocks in and out of the portfolio. All three generally have higher implied volatility stocks, kind of riskier stocks. All three are unconstrained as to which option strategies they can do. These guys in all three funds do more sophisticated option strategies. These aren't your father's covered call funds. Now, all three also have the goal of high income, and all three are actually actively managed. And I'm going to look at some of that active management tonight. I'm going to show you some of the most interesting strategies that ULTI and Kield, the two new guys, are doing to attempt to mitigate risk and earn an income. Now, I've made multiple videos about ULTY, and I have a decent size allocation of it. Generally, YieldMax and ULTY manage risk and pay an income by using something called a collar strategy. They do other things too, but kind of their go-to strategy is a collar. Now, collars are great trades. Collars when a trader owns a stock and then he sells an out-of-the-money covered call to bring in some income. But he doesn't spend all the income. Part of that money he brings in from the covered call, he uses to buy a put to put some downside protection on the trade. This trade structure gives the trader a generally uncapped or generally capped upside. So if you do this strategy, generally, if the price of your underlying goes up, you're going to go up generally slower. But they also have a capped downside. So in a big down move, you don't get stuck holding the bag. The put option cuts off a large part of the downside. It's harder for a trader, or for that matter, an ETF that's doing a collar strategy, to experience a big drop. And I think we saw that this week with ULTY, and that's part of the reason why I don't think it's done. But it's definitely has some stiff competition. Let's just say that. All right, with that in mind, let's take a look at the bottom line and see how all three of them protected capital this week. As you guys know, in the market, it was a big down week this week. But let's see how the collar strategy worked by just bottom lining it. All right, so I made a chart here of the 1 week total returns, and I put some other funds in there that are also similar just for comparison purposes. Okay, but the one that did the worst on the week, well, first of all, let's look at the market. The SPY was only down 1.6, but it rallied towards the end of the day on Friday. Now, the Qs were down about 3%. It was a pretty bad week for tech. Well, ULTI, the Rexshares fund, was actually down 11.2%. All right. And then this purple line right here is ULTY from YieldMax. It was down only about half as much, a little bit more than half as much. It did drop 6.27%, but that's those callers working for you. ULTI does a different strategy that doesn't mitigate downside to the extent that ULTY's does. We're going to talk about that in a second, and that may be changing also. And then we have right here, the best performing of the three was Kield. It was only down 5.98%. So both Kield and ULTY were only down about half as much as ULTI. Now, it's only 1 week. Kield and ULTI haven't even paid a dividend yet. They both declared this week and will pay this week. But so it's a really small sample size that doesn't even include a dividend. But with that in mind, let's look at some of the other ones. Just for comparison purposes, BLOX from X Funds is a really nice fund that I like, and I also have a good position in BLOX. Well, it didn't do great this week. It was down 9%. Now, ULTI did a little bit better than BLOX, but quite a bit better than ULTI. All right, but then also, just for comparison, we also had LFGY that was down about the same amount that Kield was down, about 6%. Then we had GPTY down about 5.5%, Chippy down about 4.5%, and then QLDY only down 3.8%. And then we've already spoken about the NASDAQ down 3%. Okay, so let's look at these newer stocks and let's and I took a look at the position. So this is what ULTY, this is the website. This is ULTY from Rex. They say it's enhanced weekly income, and they say they have downside mitigation on extreme moves. Well, I didn't see any evidence of that downside mitigation this week. However, there's good news on the horizon. So I downloaded their option trades. These are their option trades. They generally use a 4-leg option trade. So like you can see on, for instance, on Upstart, they have 2 puts, 2 calls. They're generally using a 4-leg overlay. Okay, well, the ones I highlighted in yellow, they did something special to their 4-leg overlay, and we're going to go take a look at it. But the trades where they have yellow, like for instance in Upstart, they have mitigated their downside for this coming week. For instance, in USAR, they don't have any downside protection, but in Upstart, they do. In Trade Desk, they have downside protection this week. Sarepta, they have downside protection this week. In SMR, no downside protection. In Solar Edge, they have downside protection. Sunrun, they have downside protection. NewScale, they have downside protection. In NBIS, they do not have any downside protection. In Mara, they do have downside protection, as they do in Lemonade and as they do in Figma. And in the rest of these, they don't have downside protection. They have their standard trade that they had on last week. But so how do they make downside protection? Let's look at a couple of examples. So I just put an example of this isn't one of their trades exactly, but this is the strategy they do when I say they don't have downside protection. I just used IREN for this one. They have stock and they sell an at-the-money call and a put right there. But at the same time, they buy an out-of-the-money call and then they buy an out-of-the-money put. All right. Well, what that does is it gives them a profit and loss graph at expiration that looks like this. They have they get a credit. The 4-leg option strategy gives them a credit. They get a credit, but they have unlimited downside. It'll go down just as far as the stock does. But they also have partially unlimited upside. They have a little flat spot where they don't earn extra upside. But in a big up move, if it goes past the strike they bought, the call strike they bought, they have unlimited upside past that call strike. It's an interesting strategy. And downside protection isn't everything. I mean, I'm not saying it's a bad strategy just because it doesn't have downside protection. The genius of this strategy is you get a yield, and if you don't hold it till expiration, if you manage it early, so like on this example I put in here, this expires Friday, but if they manage it Wednesday, look at the profit and loss graph. It's that right there, a straight line like that is the same profit and loss as stock. So basically, if managed early, they do have basically stocks upside and stocks downside, but at the same time, they're getting a credit. So it's a great strategy and it has merit. Well, on 12 of their positions, they're running this type of strategy. This is it's just what's this called? An iron butterfly. It's long stock plus an iron butterfly. I don't really have a name for this yet. But in any event, that's 12 of their positions. But on 9 of their positions, the ones I showed you, Sunrun, Figma, those ones we were looking at, they have, so I did one in Sunrun just as an example. They have this structure. Now, this is their profit and loss graph at expiration. All right. Well, this looks to me like a caller, and it is. This is basically a caller. Now, let me show you how they do this. They can start with the normal strategy that I just showed you on the other one, but all you have to do is, remember how I told you they buy an out-of-the-money call and they buy an out-of-the-money put. Well, all they have to do is buy 2 out-of-the-money puts, and it turns this into a caller. Now, look, the trade could still be done for a credit. You still get a credit for it. You just get a little bit less credit, but you don't have unlimited downside anymore. So if you manage this one early, it gives you a similar thing. It gives you the upside of stock, and you have the downside of stock to a point. But then once you get under the put strike, under 15, your downside is limited. So they did this position on, I'm going to call this a caller. This is a cover. It's a modified caller, and they have this on in 9 of their positions. So this coming week, maybe they see more downside coming. or maybe they just put the caller strategy on in the stocks they're more worried about. But on 12 of the stocks, so let's say the market turns around and goes up, on those other 12 stocks, they have unlimited upside. So let's go back really quick and see what they're working with. So these are their stocks they own right now. They own Sarepta, but that one had downside protection. They own Iron. They own Bloom Energy. That one, I believe, had downside protection. So did Sunrun. They own Solar Edge. That one had downside protection. Core Scientific, Figma had downside protection. I believe Trade Desk did too. But anyway, you can see here Marathon, Clean Spark, AST Mobile, US Rare Earth, Circle Internet, Upstart Holdings, Rocket Lab. These are a lot of the same stocks we see in some of the competitors. And I'm mainly thinking ULTY, but also some of the same stocks we see in BLOX. So these are definitely the stocks that are a little bit crazier, but some of them have uncapped upside and some of them have capped downside. So this should be interesting. I don't think it's necessarily an indictment on them that they lost so much this week. But I want to see how they recover. I want to see how they recover and how they adjust. But at the same time, it's not a great look that they lost twice as much as KYLD and ULTY. But we'll see how they adjust. So that's what I wanted to talk about as far as ULTI goes. I'm really excited about this fund. I can't wait for the first distribution to come out. Now let's talk about KYLD. Some people call it KYLD, but the owner, the founder of Kurv, likes to call it KYLD. So I'm calling it KYLD and KYLD in deference to Howard. Howard's a good guy. Now this is going to be a little bit in the weeds because Howard, it does some really creative option strategies, but I wanted to cover a few of them that I think you guys might, be interested to hear about. Okay. So first of all, Howard, I'm always talking about the lightning spread. The lightning spread is where you own stock and then you sell an out of the money put spread. And that's kind of the premier, kind of the go-to strategy for blocks. Well, in any event, Howard has a lightning spread on in Roblox because he owns Roblox. He owns 1,995 shares of Roblox, but then at the same time, he sold 14 put spreads. So what this gives him, the put spreads give him a credit. So he gets a yield, but the profit and loss graph is basically the same as stock, straight up and to the right. I mean, it's just, if I overlaid stock next to it, it would be exactly the same on the upside. Now, the drawback to this trade is there's no such thing as free money. This $375 credit comes at a cost. The cost is if the market drops further, the market drops past 97. Well, that's the bad news. The good news is 97 is 9% away. But should it drop past 97 and past 93, that's where they incur a loss. But if it drops less than 9.7, or if it goes up any amount, they basically have stock in this Roblox position. So this is not, they are not protected on the downside. The lightning spreads aren't protected on the downside. This is a full on bullish bet. I just thought it was interesting. They're doing lightning spreads. I picked out a few of their trades that I wanted to show you. So this one is the one this one is really interesting too. Okay. So they did this on Bloom Energy. Now this one's kind of the one I was talking about that's in the weeds, but this is basically a poor man's covered call, or you could also call it a diagonal call spread. What it is, it's where instead of owning stock for your long position to get long exposure to the underlying, you buy a deep in the money call option. And usually a deep in the money call option that doesn't expire for 2-3 months, a year, whatever. You go out a little bit and you buy a deep in the money call option. That gives you exposure until that option expires to the upside of the stock. So even though this thing is Bloom's trading around 135, they bought the 80 strike call that doesn't expire for a month. So let's pull that up. You can see right here where it says delta. See that 0.92? That's called a 92 delta. And that means it generally gets about 92% of the upside and downside, this option alone, of the move of stock. Okay, so it's close to stock, let's just say. Now the advantage is, had they just gone out and bought stock, it would have cost $13,500 to buy 100 shares. Well, this option only costs $5,800 and they're getting 92% of the upside. I'd say it's a really interesting idea. The other advantage to using an option instead of stock is if you should have a big down move, if this thing should drop to 40 or something, you don't lose any additional under 80. So it's like stock, but only from 80 up, and you only get 92% of the upside. But you're only paying, a little bit more than a third of the price. So it definitely has advantages. That's a good trade by itself, just to do the deep in the money call option. What they did to turn it into a poor man's covered call is they sold an option. They went out of the money and they sold a call. So you've heard of covered calls where you own stock and then you go out of the money and sell a call option. Well, this is a covered option, basically, because they don't have stock. No one else calls it a covered option except for me. But that's what it is. The option is they're long, and they're selling this option. Now, the thing about the option they sell, it's way out of the money, and it only brought in $200, but it expires this week. So the thing about it is, if a trader anticipates higher prices in Bloom Energy, say he thinks Bloom Energy is going to be at 150, by the end of the year or something, this trade's a decent way to express it, because you could buy this 80 strike call. It costs $5,800, but when you sell this option, it takes $200 off that price. So it really only costs you $5,600. What I would imagine they're going to do is because this option expires before this option, they could sell another option just like it next week, and next week. They could basically selling the same type of premium, bring in around $1,200. So now instead of they aren't paying $13,500 for the stock. They aren't even going to pay $5,800. As of now, they're only paying $5,600. And if they keep writing options every week, which is lots of times how these strategies work, by the time it's all said and done, they could bring in another $1,000, $1,200, and they will only have like $4,800, $4,600 in this call option. So this is a great little trade. Now, the disadvantage to it is they are capped on the upside past 165. That's the bad news. The good news is 165 is 22% away. So as long as they don't move up 22% this week, which Bloom Energy darn sure could, but in any event, as long as they don't, it's a win-win. If Bloom Energy moves down, okay, they lose money, but they only lose about 92 instead of 92% of what they would have lost had they bought the stock. And this option expires worthless, and then they could write another option next week. But if it moves up at less than 22%, this option expires worthless, and then they can do the same thing again next week, or they can cash this in. You have a lot of options with this. Excuse the pun, but you have a lot of alternatives you can do with this poor man's covered call strategy. There's several guys in my Discord that love this type of strategy, and it is a really good strategy that gives you a lot of flexibility. So I'm glad to see Howard's doing that. I'm glad to see he's doing that. Okay, now I saved the best for last. I can't believe Howard's doing this. So first of all, let me say all these funds that we're talking about tonight are what's called short volatility strategies. Covered calls are short volatility. You want volatility to generally go down. You're generally short options. Even if you have some long options, you have more short ones. That's the way all of these funds work. Well, Howard over here, at KYLD has added in a long volatility trade. So a long volatility trade is where your long optionality, where you buy options, or even if it's a spread, you're buying more than you're selling. So let me show you the long volatility trade that Howard put on. He went out to December 19th and he put on a long straddle. Now, a strangle. What a strangle is where you could either do a long strangle or a short strangle. What a long strangle is, and that's what he did, is where you buying out of the money call option and you buying out of the money put option. And you're like, I don't know which way it's going to go, but I want it to go. If it goes, I can make money. It has to, So here's the thing. A lot of people that maybe don't understand this are like, yeah, but that's stupid because it has to drop, more than 9% for this thing to pay off. You're just throwing money away because you aren't short any options. You're paying. Options have time decay. There's a disadvantage to buying them. That's why most people want to sell them. So you're fighting some headwinds here, but this is a different type of trade. The thing that this trade is, it's not really a directional trade, but it's literally long volatility. And what I mean by that is this trade is rooting for volatility to go up. So let's say we go out on Monday, and then the government reopens, and then we have a new trade deal that's perceived bullishly by the market, and something new about Bitcoin, and the market goes up, goes up big, goes up like 20%, or the market goes up 15% in the next, month or something. Well, this trade's a huge winner on the call side. But on the other side, let's say this happens. Let's say that, war breaks out in Taiwan, and, something else bad happens. The government doesn't open or whatever. Well, what that will do is, and also let's just roll it forward. Let's roll it forward to about 8 days. Let's roll it forward to Tuesday the 18th. Okay, so we're running along here. Then all of a sudden some bad news hits the market. Well, when bad news hits the market, volatility goes up. So let's say volatility goes from the IV of these options go from 23 where they're at now, and they go up 20%. So, they go up to 32 or something. They go up 30% or something. Well, at that point, you could see you can't lose. It doesn't matter where the market goes. This is literally a long volatility play. If volatility goes up, you can win. The other thing is when volatility does go up, generally the market's going to go down. So if war breaks out in Taiwan, if market, or something terrible happens, I'm not predicting that, volatility would likely double. I mean, it's so even if the market didn't move, this position would be a winner. But let's say you combine that with a 10 or 15% drop. So what you're hoping for in this is an outsized move in either direction. It's long volatility in either direction. Now, granted, it works better if it's downside volatility because it also makes implied volatility pop. But even if the market goes nowhere, but there's just increasing, concerns in the market and volatility pops a little bit, it can turn the trade into where it's a winner either way. So Howard's making a long bet on volatility, but this is just one of his many positions. His other positions are mainly covered calls and are mainly short volatility type trades. This trade right here, his diagonal call spread, or his poor man's covered call, or his covered option, like I want to call it, or whatever. This is a short volatility trade. This is a normal trade that brings in. The other way you can tell what's a short volatility trade or not is if it brings in a credit, it's a short volatility trade generally. And if you're paying a debit like you are in this trade, it's a long volatility trade generally. So I'm really interested in the three trades that Howard's doing to review. He has the, on Roblox, this is a short volatility trade also. I'm trying to think if that's even right. Well, yeah, because he's selling options. Yeah, this is short volatility trade. And short volatility trades just kind of want a normal market. They just don't want any big surprises. And that's exactly what this would, because in a normal market would mean that if this doesn't make a big drop or doesn't make a big rise, that's kind of its best scenario. In a super volatile market, the Roblox could fall through the strike prices and create a loss. But yeah, the standard thing for these option funds to do is to sell optionality, sell covered calls, sell put spreads, sell something to pay the yield. Howard's just taking I always say Howard's a riverboat gambler. This is like the third long volatility trade he's done since I've been watching the fund. The first day the fund came out, he bought an Amazon call option. He didn't sell anything. He just bought a call option. And that profits if Amazon goes up. Well, but he paid a debit. When you pay a debit, it's generally a long volatility trade. That trade paid off. So, he's doing a good job. So back to the results. I think right here, just based on this week, ULTY and KYLD, and for that matter, WPay, LFGY, and GPTY all did pretty similar. They all lost about 5.5%. Okay, but they did better than the two, the ones that are on the riskier side, BLOX and ULTI. But at the same time, they didn't do as well as some of the ones that aren't as risky. So this next week, what I'm really looking forward to this next week is we had a big down week this week. Hopefully we'll have a big up week next week. Hopefully we'll bounce back big. I just was checking Bitcoin, and Bitcoin is ramping up right now. Bitcoin went from 102 to 104 over the weekend. I would bet you anything that the market is also opened up big. So let's look at S&P futures. They just opened 15 minutes ago, 16 minutes ago. And they are, S&P futures are up 0.5 point right there. That's really good. I like to see that. So hopefully this is the start to a good week. The reason I'm really hoping it is a start to a good week, and here's NASDAQ futures actually gapped up. Look at that. They closed at 23,233 and they opened at 23,320. Great job, NASDAQ futures. Hopefully we have a big week this week, just from a selfish standpoint, because I'm going to come back and have this same show next weekend. Every weekend, we're going to look at these funds and see how they're doing against each other. And then we're going to cherry pick a few of the trades and kind of see what these guys are doing. And I think that would be, I think that's going to be a good weekly show. But next week, let's say we have a big up week. Well, I would imagine that maybe ULTI from Rex reverses, does a lot better. I would really imagine ULTI does a lot better. But as far as KYLD goes, and as far as ULTY and the rest of them go, it's anyone's guess. But it should be interesting to look at it. All right, guys. Well, let me know what you're going to do. Which one of these are you going to buy? You going to buy some ULTI? You going to buy some ULTY? You going to buy some KYLD? Some blocks? Any of the? Are you interested in any of these or none of these? Do you think they suck? Whatever, it's fine. As you guys know, I have ULTY and I'm quite happy with it. I also have KYLD and I've been happy with it. And I also have WPay and I'm planning on buying ULTI. I was going to buy it last week and I chickened out. I wanted to wait for the market to stabilize. If the market stabilizes this week, I'm going to buy some ULTI as well. I like all three of them. And I like BLOX, I like LFGY, I like everything that was on that chart. The reason I made this chart is these are the ones that I think, these funds right here, the ones that I think are on the bleeding edge. These are my favorite funds. I think these are the ones that have the best chance of paying a high yield and doing well on total return. But we'll see how it turns out. But yeah, so for this week, we really want to see if ULTI bounces back, and I would suspect it would as long as the market goes up. Now, having said that, though, as I showed you guys, they do have protection on almost half their portfolio, so maybe they'll be a little bit better positioned if the market goes down again this week. In any event, we'll come back next week and see. Like I say, leave me a comment and let me know what you thought. If you'd like to support the channel, feel free to go to paypal.me/maxconvexity, and you can leave a donation there. Other than that, I will talk to you later. I appreciate it very much, and you guys have a wonderful day.